Hello, in this video we are going to talk about different loan options. Anything from down payment assistance to investment products. Let's get right into this video. Detroit, $25,000 down payment assistance, DPA, City of Detroit, down payment assistance program. You may qualify for up to $25,000 in down payment and closing cost assistance when buying a home. The City of Detroit's down payment assistance program is funded through $6 million from the American Rescue Plan Act. Detroit Payment Assistance Program is for residents who have lived in the City of Detroit for the past 12 months, residents who have not owned a home for the past 3 years, make under one person, $43,740, two person, $59,160, three person, $74,580. Down payment assistance, DPA. Whether you are a first-time homebuyer or a seasoned veteran of the housing market, MSHDA has a mortgage product to meet your needs. I'll be discussing the down payment assistance programs available here in Michigan. These programs aim to make homeownership more accessible and affordable for individuals and families. Michigan $10,000 DPA loan, up to $10,000 available statewide. Housing education class required. Let's get right into this video. FHA and conventional loans.
The primary difference between an FHA, Federal Housing Administration, loan and a conventional loan lies in the entity that provides the loan and the guidelines associated with each loan type. Here are the key distinctions between FHA and conventional loans. Loan provider, FHA loans are backed by the Federal Housing Administration, which is a government agency under the Department of Housing and Urban Development, HUD. In contrast, conventional loans are not insured or guaranteed by any government entity. Down payment, FHA loans generally have more lenient down payment requirements compared to conventional loans. FHA loans typically require a minimum down payment of 3.5% of the purchase price, while conventional loans often require a down payment of at least 5% to 20%, depending on the specific loan program and borrower qualifications. However, it's important to note that lower down payments for FHA loans are balanced by the requirement of mortgage insurance premiums, MIP. Mortgage insurance, FHA loans require both an upfront mortgage insurance premium, UFMIP, and an annual mortgage insurance premium, MIP. The UFMIP is typically financed into the loan amount, while the MIP is paid monthly as part of the mortgage payment. This mortgage insurance protects the lender in case of default. In contrast, conventional loans generally require private mortgage insurance, PMI, if the borrower's down payment is less than 20% of the purchase price. However, once the borrower reaches a loan-to-value ratio of 80% or less, PMI can be canceled. Credit requirements, FHA loans are known for being more forgiving when it comes to credit scores and credit history. Borrowers with lower credit scores or past credit issues may still qualify for an FHA loan. Conventional loans typically have stricter credit requirements and may require higher credit scores for approval. Loan limits, FHA loans have specific loan limits set by the government, which vary by county. These limits determine the maximum loan amount that can be borrowed using an FHA loan. Conventional loans generally have higher loan limits, but they can vary depending on the loan program and the borrower's financial situation. Property eligibility, FHA loans have certain property eligibility requirements. The property must meet specific standards regarding safety, security, and habitability. Conventional loans have fewer property requirements, but the property must still meet the lender's standards. Interest rates for FHA loans are typically fixed and may be slightly higher than those for conventional loans. Conventional loans offer a variety of interest rate options, including fixed rate and adjustable rate mortgages, giving borrowers more flexibility. It's important to note that these are general differences, and specific loan terms and conditions can vary among lenders and loan programs. Borrowers should consult with mortgage lenders to understand the specific requirements and benefits of FHA and conventional loans and determine which option best suits their financial situation and homeownership goals.
Let's get right into this video. VA loans.
A VA, Veterans Affairs, loan is a mortgage loan program specifically designed for eligible veterans, active duty service members, and certain surviving spouses. Administered by the Department of Veterans Affairs, VA loans offer several benefits to help veterans and military personnel achieve homeownership. Here are the key features and qualifications of VA loans. No down payment. One of the most significant advantages of VA loans is that they often require no down payment. Eligible borrowers can finance up to 100% of the home's purchase price, reducing the upfront cost of homeownership. No private mortgage insurance. PMI. Unlike conventional loans, VA loans do not require borrowers to pay private mortgage insurance. This can result in significant savings over time. Competitive interest rates. VA loans typically offer competitive interest rates, which can help lower monthly mortgage payments compared to other loan programs. Flexible credit requirements. VA loans tend to have more lenient credit requirements compared to conventional loans. While specific credit score requirements may vary among lenders, borrowers with less than perfect credit may still qualify for a VA loan. Funding fee. VA loans require a funding fee, which is a one-time fee paid by the borrower. The funding fee helps offset the cost of the VA loan program and can be financed as part of the loan amount. The fee amount depends on factors such as the borrower's military category, down payment amount, and whether it's the borrower's first time using a VA loan. Loan limits. VA loans do not have a maximum loan limit. However, there are limits on the amount the VA will guarantee. The limits vary by county and are based on the conforming loan limits set by the Federal Housing Finance Agency. Property eligibility. VA loans can be used to finance various types of properties, including single-family homes, condominiums, and multi-unit properties, up to 4 units. The property must meet the VA's minimum property requirements, MPRs, to ensure it is safe, habitable, and structurally sound. Certificate of eligibility, COE. To apply for a VA loan, borrowers need to obtain a certificate of eligibility from the VA. This certificate confirms the borrower's eligibility for a VA loan based on their military service, length of service, and discharge status. It's important to note that while the VA guarantees a portion of the loan, VA loans are issued by private lenders such as banks and mortgage companies. Borrowers should contact VA-approved lenders to explore their options, understand specific requirements, and navigate the VA loan process.
Let's get right into this video. Commercial loans.
Commercial real estate loans are used to finance properties intended for business or investment purposes, such as office buildings, retail centers, industrial facilities, and multifamily residential properties. The specific requirements for commercial real estate loans can vary among lenders, but here are some common qualifications and documentation typically needed. 1. Property evaluation. Lenders will evaluate the property being financed to assess its value, income potential, and suitability as collateral. This involves a thorough property appraisal, including an analysis of market conditions, rental income, occupancy rates, and the property's condition. 2. Borrower's financial strength. Lenders will assess the borrower's financial stability and capacity to repay the loan. This includes a review of the borrower's credit history, credit score, and financial statements, such as income statements, balance sheets, and tax returns. The lender may consider the borrower's net worth, liquidity, and debt-to-income ratio. 3. Down payment and equity. Commercial real estate loans typically require a down payment or equity contribution from the borrower. The percentage required can vary but is often between 20% and 35% of the property's purchase price or appraised value. The borrower must have sufficient funds available to meet this requirement. 4. Debt service coverage ratio. DSCR lenders analyze the property's ability to generate enough income to cover the loan payments. The DSCR is calculated by dividing the property's net operating income, NOI, by the annual debt service, loan payments. Lenders typically look for a DSCR of at least 1.2 to 1.4 or higher. 5. Business plan and projections. Borrowers may need to provide a comprehensive business plan, particularly for investment properties or new businesses. This plan outlines the property's income potential, market analysis, tenant profiles, and growth projections. 6. Property insurance and leases. Lenders often require evidence of property insurance coverage to protect their investment. Additionally, for income-generating properties, lenders may request copies of lease agreements or tenant profiles to assess the stability and potential cash flow. 7. Environmental and legal considerations. Lenders may perform environmental assessments to identify any potential environmental risks associated with the property. Legal documentation, such as property titles, surveys, and zoning information, may also be required. 8. Personal and business guarantees. Depending on the borrower's financial strength and the loan structure, lenders may request personal guarantees from the borrowers or guarantees from the business entity associated with the property. It's important to note that these requirements can vary depending on the lender, loan amount, property type, and the borrower's specific financial situation. Consulting with commercial lenders and experienced real estate professionals is advisable to understand the specific qualifications, terms, and documentation needed for commercial real estate loans.
Let's get right into this video. DSCR loans.
A DSCR, debt service coverage ratio, loan is a type of commercial loan that evaluates the borrower's ability to cover their debt payments based on their income generated from the property or business being financed. The qualifications for a DSCR loan typically focus on specific criteria to ensure the borrower can meet their loan obligations. While specific requirements may vary among lenders, here are some common qualifications. DSCR calculation. The primary qualification for a DSCR loan is the debt service coverage ratio itself. Lenders calculate the DSCR by dividing the property's or business's net operating income, NOI, by the total debt service, including principal and interest payments. The minimum required DSCR varies but generally falls between 1.2 and 1.4, indicating that the income should be 1.2 to 1.4 times greater than the debt payments. Income documentation. Borrowers typically need to provide comprehensive documentation of their income sources. For rental properties, this includes rent rolls, leases, and historical financial statements. For businesses, lenders may request tax returns, profit and loss statements, and other financial records to assess the income generating potential. Property evaluation. The lender will assess the value and condition of the property being financed. This involves conducting an appraisal to determine its current market value and reviewing any existing lease agreements or tenancy details. The property should be able to generate sufficient income to meet the debt obligations. Borrower's creditworthiness. Lenders evaluate the borrower's credit history and financial stability to determine their ability to manage debt. They review credit scores, credit reports, and may consider factors such as previous loan repayment history, outstanding debts, and other financial obligations. Cash reserves. Lenders often require borrowers to have adequate cash reserves as a safety net. These reserves act as a cushion to cover unforeseen expenses or temporary income shortfalls, ensuring the borrower can continue making debt payments even in challenging circumstances. Business or property experience. Lenders may consider the borrower's experience and expertise in managing the specific type of property or business being financed. This is especially important for loans involving specialized properties or businesses with unique operational considerations. It's worth noting that different lenders may have additional or slightly different qualifications for DSCR loans. It's advisable to consult with specific lenders or financial institutions to understand their specific requirements and guidelines for obtaining a DSCR loan.
Let's get right into this video. Fix and flip loans.
A fix and flip loan is a type of short-term financing that is specifically designed for real estate investors who purchase distressed properties, renovate or fix them, and then sell them quickly for a profit. These loans provide funding for both the purchase of the property and the necessary renovations. Here are the typical requirements for a fix and flip loan. Real estate investor status. Fix and flip loans are available to experienced real estate investors and first-time investors. Lenders may require borrowers to have a track record of successful real estate investment projects or proof of prior experience in property renovation and resale. Down payment. Fix and flip loans often require a significant down payment, typically ranging from 10% to 30% of the total project cost. The borrower needs to have adequate funds available to cover this upfront payment. Property evaluation. Lenders will evaluate the property's value both before and after the renovations. They will conduct an appraisal to assess the current market value and determine the property's potential after the necessary repairs and improvements are completed. Renovation plans and budget. Borrowers are required to provide detailed renovation plans and a budget outlining the scope of work and estimated costs. This helps the lender assess the feasibility of the project and ensures that the loan amount is sufficient to cover the renovations. Contractor documentation. Lenders may require borrowers to provide information about the contractor or construction team responsible for completing the renovations. This can include contractor licenses, references, and proof of insurance. Exit strategy. Lenders will want to see a well-defined exit strategy, which typically involves selling the property at a profit within a relatively short period. They may require a marketing plan or evidence of a prearranged sales contract to ensure that the borrower has a clear plan for repayment. Creditworthiness. While fix and flip loans are primarily asset-based loans, lenders may still consider the borrower's creditworthiness. A good credit score and a clean credit history can enhance the borrower's chances of securing the loan and obtaining favorable terms. It's important to note that the specific requirements for fix and flip loans can vary among lenders. Some lenders specialize in these types of loans and may have more flexible qualification criteria compared to traditional banks. It's advisable to research different lenders, compare their terms and requirements, and work with a lender experienced in fix and flip financing to find the best fit for your needs. So for any questions, you can leave a comment below or go to www.loansbywill.com. I hope that helps.